Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show.
All right, Phil, I'll try not to make, I'm going to make my same joke I always make. To Roth or not to Roth, that's the question.
There you go. To Roth or not to Roth.
It's just too easy to do. Right, it's there. Yeah. But with the wrinkle of at 55, right? So that's going to be the topic this week is, Roth or traditional, which makes sense, right? Which 401k makes sense for you at 55, and is it too late to have that conversation as well? Because again, we get questions in all the time. You get them into the websites. You get all kinds of stuff that comes in, and so I wanted to talk about this one this week, and we'll put this up on the screen for folks. But here was basically the scenario. I started a new job, and I'm familiarizing myself with the 401k at the new company. It seems that I have the option to make normal 401k contributions or Roth contributions instead. I've never had that option to do the Roth 401k before, so I'm intrigued by it, but wondering which option is the best for me. By the way, I'm 55. So let's break this down for them a little bit because the Roth 401k is a really powerful tool, newer tool as well.
Newer in relative terms. It's been around a long time, but it's
10, 12 years, but yeah.
Yeah, it's becoming more and more mainstream. More companies are actually offering it now. So
well let's start with just the core difference then, I guess. Let's just kind of base it there. Where we go there?
Yeah, so just like the Roth IRA discussion, it's the same thing. The core difference is when are you going to get the tax benefit, right? On a traditional 401k, you receive that tax benefit today, but it's a deferral, right? So you get to deduct or not pay tax on monies that go in, but then growth on that money over the years, you have to pay tax on the whole benefit that comes out later on versus a Roth. You don't get the deduction today, the contributions that go in after tax, but now all that growth becomes tax-free in the future. So kind of an easy analogy that I use often is paying tax on the seed or the harvest, right? So the Roth is the seed. You're paying tax on that seed up front, the money that goes in. Now the future growth is all tax-free. Versus the other way, you're paying tax on the harvest at the end. Once you take money out, all of the proceeds are taxable because you took a deduction on the way in.
Right.
So those are the primary differences between them.
Okay. And a lot of times, for years, people were like, well, I'm going to put money into the 401k at work. And then I've also started my own Roth that I'm feeding, but the Roth limits were lower. So the Roth 401k does offer this kind of nice hybrid where you can now pump in, usually the same amounts, right? The higher income amounts. For that Roth 401k. So that's something to consider too, because a lot of times people were doing the other Roth, or they were doing the traditional, and then doing the conversion, right?
Or doing a Roth IRA.
Right. Yeah. So does 55 make that a challenge when thinking about, changing the Roth versus the traditional?
No, age doesn't really play into it. Income does, which kind of goes along with age. Typically, if you think of kind of the traditional trajectory of work, in your job, your career, you probably earn more each year along the way. So assuming you're in your mid to late 50s, you're nearing those peak earning years, probably. Yeah. If everything is played out in a more traditional fashion. So that being said, it's very likely that you don't have that option now to make a Roth IRA contribution. So that's one advantage you do have in the Roth 401k is there is no income limitation. Doesn't matter what you make, you can decide when you put the money in, is it going to be traditional? Is it going to be a Roth? And it can be a split between the two of them. You don't have to decide all or nothing.
How effective is that strategy? I know people sometimes feel like, is that a good way to go? Because it's like, well, all right, I'm lowering my taxable income by doing the traditional, right?
Right.
But then I'm also growing.
To me, often that's just somebody that doesn't know, right? They didn't run the numbers. They don't have an idea, so I'm going to try to do both. Oh, okay. That's, no right or wrong answer, really. It's more probably of an uninformed decision of I'm going to hedge my bet and do both of them.
Gotcha.
To me, the right answer in this is really looking at the bigger long-term picture. In every scenario is going to be different. I would say for most individuals, if you're on that trajectory of kind of that traditional career type history, and you are in your peak earning years, and you might not be as high of income as you are today in retirement.
Okay.
So again, this isn't just an off the cuff. You really have to run the numbers and kind of see where you're at.
Right.
So let's put some numbers to it. Let's say you're in the 24% bracket today with your, tax scenario because of where you're at from an earning standpoint. But when you've run the math and your makeup of income later on in retirement, you're only going to be in the 22.
Okay.
Well, then it may make sense to go ahead and do traditional today because you are getting some arbitrage. You're getting a tax benefit of 24.
Gotcha.
When the money comes out, it's coming out at 22.
So is the current tax bracket carry more weight than the future one?
No, you've got to look at both of them kind of in conjunction.
Okay.
It really, the current one is relevant to what you think the future one's going to be.
Okay.
If your current bracket is anticipated to be higher than what you think it's going to be in the future, then it would make sense to do traditional.
Well, and don't get sucked into the traditional thought that, well, I'm just going to lower tax bracket nationally when I retire, because you may not be. Right?
Yeah, don't do that. That's why I was saying run the math.
Yeah.
Because most people just assume, it's going to, I'm going to be in a lower bracket.
Well, we've been told that for 40 years. So
right.
Yeah.
And for most people, if you're in that 22% bracket, the 22% bracket's a wide bracket.
Yeah.
Great point. The reality is very likely you're going to, if you're earning there, you might be in the top of that bracket while you're earning, but in retirement, you might end up being in that bracket still, but just in the lower part of the bracket, but you're still in the 22% bracket.
Gotcha. Yeah.
So in that case, there isn't a tax arbitrage you can gain by going into traditional versus Roth today. So then to me, it would almost make more sense to do Roth. And the reason that I would say that would be is that now we're hedging future tax rates. Because that's the other side of the equation you have to look at in this traditional versus Roth is, we plan based on current tax rates today. So, if you anticipate to be in a same or lower bracket in the future, then traditional makes sense. The same bracket or the same bracket today as in the future in retirement, then Roth probably makes sense. But the challenge with all of those is I don't know what that future bracket is. So the thought there is, okay, you're hedging by doing the Roth, you're hedging the potential that tax rates will go up in the future. So that's kind of a personal decision.
Yeah.
Personally, from my standpoint, I think they will. I think it has to at some point.
$38 trillion. Yeah.
Right. They haven't fixed the debt. They're still spending at a deficit every year, spending more than we're making.
Yeah.
So they're building the national debt. They haven't fixed the problem, and there's only so many ways to fix it, and taxes is the easiest one. So
right. Yeah.
That is the downside to the traditional IRA 401k is that you are postponing that tax until the money comes out. So what you pay is determined when the money comes out, the rates when the money comes out, which we don't know.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
I think statistically, currently, over the last probably 15 years or so, more people stay in the same tax bracket in retirement as when they walk into it, coming out of their working years into retirement. Whereas, the old way of thinking was, well, you'll be in a lower one. That's not really been the norm for probably closing on a generation at this point.
No.
And you're talking about the responsibility of the government. Political affiliations aside, there's not been a fiscally responsible president since Clinton, and that's just factual. Former comptroller David Walker, who worked for both Reagan and Clinton, even says that. He's like, look, the last fiscally responsible president was Clinton, like it or not.
Yeah, right? He had a balanced budget, so we haven't seen that since. So,
exactly. So the reality is that taxes probably will go up. So I would say that the chances of being in a lower one versus the same or higher is probably less, right? So you're probably going to be in the same or probably going to be in higher. So you certainly want to take that into account. And, I always make this joke too, Phil, but it's kind of true because we do kind of get told that so much that people do tend to believe it, especially of a certain age. it's not like you get gifted a lower tax bracket as a retirement gift, right?
Correct.
They don't get, you don't get a gold watch and a pension, blah, 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 blah.
And a lower bracket.
And a lower bracket. It would be great if they did, hey, you're 65, now you're permanently in a 12% tax bracket until you die. That'd be awesome, right? And if anybody on the government wants to make that happen, you could call it the Mark Bill. I don't care. But you don't get it unless you plan for it. Right. You cannot be in and I think that's the other takeaway too. Like maybe you could be in a lower tax bracket in retirement, but you have to plan and strategize for it. It doesn't just happen.
And that is the key is having that plan and strategy, not just trying to make this decision off the cuff. Run the math, look at it and see what your scenario looks like. I mean, there are some general rules and thoughts around it. Typically if you are in a much higher bracket, maybe the 35, 37%.
Right.
Well, chances are you're going to be in a lower bracket, but maybe not. I don't know your lifestyle. I don't know if you've got 20 million saved and you're spending 400,000 a year, well, then probably not. It all comes down to what your lifestyle and scenario is.
Yeah. So I was going to say there are other factors to take into account. Back to this email question. Do they put it in the traditional 401k or do they do the Roth 401k at work? Right. Yep. So, and they're 55. So 55. So the age doesn't seem to make a difference to you, right? As far as that goes.
Yeah. Okay. I mean, it really comes down to the math and your specific scenario from a long-term perspective and looking at it from looking at it through that tax lens.
Okay. So when you're faced with this option at work, we typically don't have, a lot of times we just kind of elect something because we just we're doing, first day paperwork and HR stuff, and we just kind of check it and go in. If you do feel like you've elected the wrong thing, can you do something about that later on?
Well, it's going to depend on your plan.
Okay.
So most plans do give you options throughout the year. Some of them are maybe once a quarter, once every 6 months. Some of them don't have a limit. You can change it every payday.
Okay.
But most time plans are going to limit it just because from an HR standpoint, if they open it up and somebody decides that they want to change it every payday, I mean, that's a headache.
That's a headache, yeah.
Because every payroll they're trying to change it. Oh, what's it doing this time? And, so that's why most of the time you are going to have some kind of limitation, maybe once a quarter, once every 6 months. Look at what's called your summary plan description, or talk to HR. In there, it'll tell you how often and when you can make that change.
So if you feel like, hey, I've elected the wrong thing, or I want to run the math, go see a financial professional, get the numbers put together, and then the next time, for lack of a better term, enrollment or open enrollment or whatever you want to call it is available, right, for your plan change. Right? Typically, at least it's once a year anyway.
Right.
Then just then just make that change then, but at least then you'll be armed with the math. So
correct.
Any final thoughts?
No, I mean, Roth is a great option. Don't, like any decision, don't get tied up in the hype.
Yeah.
I got to have a Roth. Makes the most sense. Well, maybe not. I mean, Roth is an incredible tool. We use it a lot with clients. We do a lot of Roth conversion planning. So for those that haven't taken advantage of the Roth 401k and have put everything, into the traditional,
right.
Doing Roth conversions later in life are a way to kind of right that ship and get the balance from a tax aspect back into your retirement accounts. But I mean, if you can hedge that up front and start putting more money in the Roth up front, then could make sense. Generally, general rules of thumb for a younger worker, absolutely it's not even a question. You've got time, huge amounts of time, and you're in the lowest tax bracket probably of your career.
Sure.
So why would you want to take a tax deduction today at the lowest rate and pay more in the future? Doesn't make sense. Do the Roth.
Yeah.
Generally, right?
Generally, yeah.
Once you get into the later stage of your career, now it becomes a math question. You got to really run the math, look at your scenario closer to see what it looks like.
Great point. Yeah. All right. Well, there you go. So thanks so much for the email question. We certainly appreciate it. As always, don't forget to subscribe to us on Apple, Spotify, and of course, right here on YouTube. Hit that thumbs up, ring that notification bell, and that way you catch new episodes when they come out. And of course, if you got any questions or need some help, reach out to Phil. All the information's in the show descriptions as well as on the screen. And drop us a comment down below. Do you think there's a right or wrong time to take it? What's your thoughts on taxes? Do you think taxes are going to go up in the future? Leave us a comment down below, and we'll feature different things on the show here as well. So appreciate your time as always, folks. And Phil, appreciate your time, my friend. We will see you next time here on Phil's Tax Hacks and Other Retirement Facts with Phil Putney.
Phil? investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.